If you're anything like me, you've had a moment in your life, and maybe it's right now, where you have felt like, boy, things just seem to get slightly tougher all the time financially, and I can't pinpoint exactly why it's happening, but I feel like somehow there must be a way for me to do better. You're right to feel that way, and I'm going to explain to you why. In this video, I want to cover 4 things. Number 1, why savings alone is not going to get you ahead for the future. Number 2, we'll talk about the power of compounding investments over time. Number 3, I'm going to show you the most common mistakes that people make so you can avoid them. And finally, if you're ready to get started at the end of this, I'm going to show you how to get started so you can actually begin investing and changing your future. There are 2 trajectories possible from this point as you're watching. I want to show you how to get onto the better trajectory and not stay where you're at, feeling like something's wrong and not sure exactly what it is. Let's go. Let's start out by talking about why savings alone is just not a good enough solution. In order to give you a better understanding of savings and why it doesn't work, let's go back to the early 1980s. Paul Volcker takes over in 1979 as the Fed chair, and he's there for 8 years. And during that time, there was high inflation, and Volcker raises the interest rates, and he raises them near 20%. Now, what that does is it takes people who are looking for new debt and it discourages them. It's very hard to afford anything with that kind of an interest rate. But what it does incentivize is a lot of savings. Money is being pulled out of the system because if you take it to the sideline and put it into a bank, you're going to earn interest on it. That causes money in the system to dry up and prices to come back down. It causes deflation in the system. We are seeing the opposite effect today. Today we have interest rates that are really low. They're like 4%. Now that might seem high compared to what you've seen in your lifetime, but historically it's very low. And our real inflation, not the government numbers that are manipulated, but real inflation is above that number, meaning that you might earn 4% in the bank, but prices are going to rise more than 4%. And by the time you get to the thing you want to buy, it's going to cost you more than it would have when you started saving. The system is set up in a way where money is cheap, interest rates are low, and people are incentivized rather than leaving it in a bank to earn interest to just pump the money into the system. Buy what you can today because it's going to be more expensive in the future. But that leaves us with nothing. So it's like putting us into you've heard of like the rat race or running on a hamster wheel or whatever. That's what it feels like because we're falling behind all the time, trying to keep up, trying to buy the next thing before it gets more expensive. And there's no reward for savings. It would be great if we could get back to the days where we had high interest rates and saving money actually did reward you. Unfortunately, that's never going to happen. And the reason is, currently in the US, we have a national debt load of $38 trillion. It's rising at the time, even as I'm recording this. And that equates to almost $329,000 per person that pays taxes in this nation. That is a crazy amount of debt that we've accepted, and it continues to grow all the time. Now, the reason that we could raise rates so much back in the day is that the US had a very small national debt compared to what we currently have. Servicing the debt today at today's rates costs about $1 trillion per year, and that cost will continue to rise over time. Now, if you were to raise the rates from 4% up to, say, 20%, you can understand why suddenly this is no longer feasible, why we can no longer handle our debt, and the debt load would just crush everything. So we're not going to be able to really raise the rate to where it needs to go. So there's 3 major things that we can do about the debt right now. We can raise taxes, which is wildly unpopular, and no politician will ever do it because they will not get reelected. We can reduce spending, wildly unpopular because people have been promised benefits and they hate having them taken away. Or we can print the debt into oblivion. And that's what we've chosen to do because it's a hidden tax. And what happens is that the government runs a deficit every single year, okay? And the money gets pumped into the system. And what it does is it dilutes the purchasing power that you have. So whatever you have sitting in the bank, let's say in savings, or whatever you have that's in your accounts, it's slowly just getting diluted. Money gets pumped into the system, it gets used up, and it gets sucked up into assets. It goes towards the things that have value. It'll go towards things like rental homes, the stock market, Bitcoin, gold. It goes towards like anything that is real and tangible. And what's happening more often than not is that we see the stock market constantly rising because money eventually goes towards the things that have value because people who know what they're doing are buying up real assets. If you're not one of the people who's buying real assets, you're just slowly having your purchasing power stolen from you by money printing, and it's being moved towards the rich. This is why you hear that the rich are getting richer and the poor are getting poorer. This is the reason. That means if you don't want to continue falling behind, you got to get some assets. You and I need to try to acquire real assets that have value, because if we don't, then the money just continues to disappear in consumption away from us and towards the rich, towards those that hold assets. There's your explanation of why we got to do something. Now let's talk about what that actually is. Let me give you a quick example of the power of compounding investments over time. So let's say it's 2018. I hand you $1,000 and say, go invest this in whatever you want. You run to the stock market and you find a company called Vici, V-I-C-I, and you say, I want to invest $1,000 into this company. That would buy you 55 shares at the time. So I'm putting up a chart here, and I want you to take a look at this. I've got 55 shares when I start, when I spend my $1,000 on Vici. By the end, I end up with 80 shares and $130 a year in dividends. My first year that I'm paid dividends, it's $35. So a significant increase. That's both due to the fact that I'm picking up shares along the way by reinvesting the dividends, and the dividends are growing over time. The company is slowly raising those dividends as they continue to make more money every year. So it's allowing this compounding effect to take place, and you can see that time is your biggest ally here. The more time that you have your money in the market, the better off you are. You can see that by the time we get to year 6, we've more than doubled the investment, and we've picked up a substantial number of shares. When I built the thumbnail for this video, that's why I showed 2 trajectories. This is your savings trajectory. It's just sitting near flat. It's like slowly increasing a little bit every year. And your investment curve is going parabolic because it begins to just build momentum and build momentum and build momentum, and it really pulls away over time. Hopefully at this point, you're saying to yourself, okay, man, I need to get started. This is important. I got to do it. Great. Let me give you just the warning, the heads up of the common mistakes that people make so you don't make them, and then I'll tell you how to get started in this process. The most common mistake that's made, you've probably guessed it already, it's not getting started in the first place. People who, like me, said, I'll get to that eventually. I spent probably 8 years of my life where I could have been investing absolutely nothing, and it put me way behind the 8 ball. So hopefully today is the day for you, and you say, I'm getting started, let's go. Mistake number 2 is thinking you need like a windfall to start. If I inherit some money, if I win the lottery, whatever it is, if you're waiting for a windfall to get started, you'll probably never start. And I get myself in a financial place where I feel good about my finances, then I'll start investing. That's a formula to get yourself way behind. You got to start, even if it's small, $50 a month, $100 a month. You can do it. Set an amount and just start piling the money in. Whatever you decide to do, make sure that you have some extra money and some cushion. Try to put yourself in a spot where you don't need this money. This is why I approach things by playing poker as a second income, so I can take care of my bills and all my normal stuff with my job, and my extra money is just, it disappears. I don't even think about it. It's just gone. It's money I don't have to touch. Not a big deal. The next thing, I'll give you a story here. The next thing is doing no research. When I first got into investing, I was like, okay, I know I need to invest. So I'm going to take some money and I'm going to buy a bunch of something I am familiar with, which is casinos. And I bought a bunch of stock in Caesars property. And it was at a terrible time when the company was, I can't remember if it was pre-pandemic, but I had bought all these shares and the company was going through some kind of a like restructuring, and the stock just fell every single day. And the news was out there. If I had just read a couple of articles, I would have seen that they were dealing with potential bankruptcies and they were having problems financially. But all I did was went,
well, casinos are big and they've been around forever. I guess I'll just buy that.
Terrible investment. Don't do it that way. Try to do some investing in research. And if you don't want to do research, if you're like, hey, that's not for me, I don't have the time for it, then you can just buy index funds. I don't recommend this as much, but it is better than nothing. If you buy the S&P 500 index fund, you're buying this big basket of companies. I think you can buy the absolute best companies out of there and you'll get a higher return. But if you're like, hey, I just want to receive some cash by owning companies that are out there that people are familiar with, it's not the worst way to do it. You're going to receive some kind of like a 7-8% return on your money on average. Historically, that's what it's been, which means you're getting something for it. I would highly recommend doing your research. And if you want information on what I'm looking at, how I research a company, and what I look at before I make a purchase, let me know down below. I'd be happy to put that video together for you as well. Let me give you an example of like a mistake that might be really common to make. Let's talk about AT&T. AT&T pays a dividend, but if you go back and you look at their information, you can see that revenue-wise, in 2007, they made $29 billion in revenue. In 2025, they made $30 billion in revenue, meaning that over the course of almost 20 years, they've not grown their revenues at all. The company has not grown at all. So what can be really enticing is they've paid a high dividend over time. Like for a while, they had a really nice dividend, but the dividend recently has been cut. It had to shrink because they couldn't continue to pay it because they didn't have any revenue growth and they could not continue to raise their dividend. They're not growing their free cash flow. In other words, they're not bringing in any more money than they were in 2007. They're bringing in about the same amount. So this is a company that, yes, they're going to return something to you. They are making some money, but I like to look for compounding machines, ones that you buy and they return money to you and they're growing at the same time so that over time they're going to return more and more and more and more money to you. You want to try to buy companies like that. Another really big mistake is to buy a company when it's running up really high above what it's been. So let's say its previous all-time high was $100 and all of a sudden it's at $150 and rising. That's probably not the time to be buying in. When it's made a big run like that and a ton of money has come in to invest in, you're setting yourself up where you have probably very little left that you can gain from here and a lot of potential downside if people say, hey, you know what, I've made a lot of money. I want to go ahead and realize that gain. So I'm going to sell the share, and people see the selling starting to take place and then they want to realize what they've made on the stock. So then they start selling and all of a sudden it starts falling and falling and falling. You want to be the guy who says, hey, I'm going to wait. And if it never comes in, that's okay. Finally, I will say, and this is really easy to do, but it's really easy to try to predict the market and to be managing your stocks too often. And so what's really easy to do, though, is to go, oh, no, I bought it and now it's crashing and should I sell it? And then you sell and then it starts coming back and you go, oh, it's coming back, and you buy and then it turns around again. And you're like, oh, no, it's falling. I'm going to sell. And you're losing on both sides, back and forth and back and forth. So decide you want a company, make your purchase, and then just hold. Now let's talk about how to get started. I'm not going to recommend any app for you. You can use Robinhood or I personally use Schwab. It doesn't really matter, but get into something that's going to allow you to trade without any kind of a fee, which is almost all of them these days. And when you get your account set up, you'll have the choice of a traditional or a Roth IRA. You can basically choose your investment path. My account is a Roth. It grows tax-free, and then I'm able to pull the money back out because it's already been taxed when it went in. So this screenshot is from Charles Schwab. When you're setting up an account, here's what you're going to need. You need a social security number, driver's license, employer's name and address, statement information for any assets or cash you want to transfer, and beneficiary information. That's what you need to get it set up. It doesn't take that long. You get the account going. Then when you're ready to fund the account, you're just going to link it to a bank account and you can transfer money in from your bank account. Figure out what amount you want to contribute and just be consistent with it. So if it's $20, if it's $100, if it's $500 or $1,000, whatever it is, you just put your money in every month. And then what I like to do whenever I make a contribution is I like to just kind of look over where I'm at, see if there are shares of a company that I'm ready to buy or anything that I've really been excited about. I'll make some purchases and then I just will leave the account alone, and I keep an eye on it. I watch it, but I try not to do a bunch of trading, and I'll look forward to what I want to buy next so that next time I come in with more funding, I know what I want to spend it on. Hey, before you get out of here, comment down below with your financial goals. I'm rooting for you. We're all in this together. We're all trying to fight the good fight, provide for our families, and just try to keep our heads above water here as things get harder. But yeah, I hope this was helpful to you. If it was, please like it and sub it. That'll get it to more people. I really appreciate that, and I will talk to you in the next one.